So tell me more about the 757 or 757 Collab. You started about 2.5 years ago, and now you have 757 Angels, 757 Accelerate, 757 Defend, and 757 Startup Studio. What it is all about and how it is helping the ecosystem, how it all started.
Yes, absolutely. So it really is a testament to the visioning and the hard work and the passion of the region, this region of Virginia, the eastern part of Virginia, commonly called Hampton Roads, but also the area code here is 757, hence the name 757. Collab, 757 Angels. So really, 10 years, about 10 years ago, maybe 11 years ago now, 757 Angels started with a group of business leaders and a good friend of mine and colleague, Monique Adams, who founded or was the first executive director of 757 Angels. That was successful in its endeavor to catalyze investment, local investment in local companies. And then out of that, started 757 Accelerate, which is our accelerator. And then about 4 years ago, another effort was undertaken by Monique and her team and Evans McMillian, who was the leader of 757 Accelerate in our region. And they formed 757 Collab. So where we are today, as you said, I came in about just over 2 years ago to take over from Monique and from Evans, who were retiring. And right now we are uh, a fairly complete venture hub or entrepreneurial support organization. So we have an incubator, we have our accelerator, we have our actually fee for service line of business, and then our angel network, 757 Angels, is an affiliated organization that we brand underneath Collab because it kind of completes that continuum. We will be looking to add a pre-accelerator in 2026.
Okay, great. So it sounds to me that it is a complete model for achieving success for the regional entrepreneurial and startup ecosystem. You have all the blocks in place where they can migrate from one to the other, and then the whole ecosystem come together. Did I summarize it well?
You did. I mean, it's very elegant on paper. In practice, it's a little tougher, but you are absolutely correct. That's
Right.
kind of that was the genesis of this concept, and then in reality, we strive every day to try to create that continuum where companies can come in really at any point and find their way through the startup journey, and we like to think that we can add some value along the earliest stages.
Right. So, Paul, take me to your earlier life. How did you start? Why did you start looking? When did you start looking at startups? And
Yeah, it was a
what
little bit
got you?
it was a little bit untraditional. I mean, typically, you either are a startup founder who exits and maybe gets into startup investing, or maybe you're an investment banker, and once you're done with your investment banking stint, you go into venture capital. And mine was a little bit different. When I came out of college, which was in 2001, entrepreneurship really wasn't a focus. I mean, it was people were doing it, but it wasn't really a thing. And so I got into banking. I wasn't a doctor. I wasn't a lawyer. So why not be a banker? Not an investment banker. I was in wealth management and did some commercial banking. And then through time and space, really, it was during my wealth management days that I started to see how founders that had monetized their hard work and created, significant wealth, how that whole ecosystem was, and I kind of became enamored with it. I had a very close friend, avid close friend, who did precisely that. He started a company and sold it, and created multi-generational wealth. And I was fortunate enough that he asked me to come in and help manage his deal flow. So once he turned from an operator to an investor, and then that really got me started. And then, as I like to say, I was at the right place at the right time and knew the right people that were willing to give me a chance to do this full time. And I was already doing it kind of on the side, moonlighting for free as a passion, and then to get paid to do your passion. You can't ask for anything better than that. So really, that's how I got into early stage investing. And then through that, you realize very quickly it's not just investments, it is ecosystem building. So it's kind
Yeah.
of all in one.
Mhm. Yeah. So you must have seen what many tens of thousands of pitch deck in your career so far, and then the demo days, and taking them through, scanning them, identifying from the deal flow that which are the company who will be pitching. What separates from a fundable founder to a good pitch or a good pitch deck kind of a founder?
Yeah, I think there's a couple things. Not to sound cliche, but it does start with the person and often ends with the person. So, you're investing at the stages that I look at, which are angel to early seed. It really is about the team and about the people because that's who you're investing in. So somebody who's humbly confident really resonates with me. Somebody who has executive function, they know what they know very well, but they know that they don't know everything. And so they're willing to listen. They're willing to receive feedback. So I think, the type of pitch deck I like to see or to hear or listen to is one that's going to instill some passion in me for whatever concept or visioning that is. Something that I think encompasses or appreciates the macro trend or, or of the industry in which that solution is being placed into. Um, Again, the founders who have either a deeply personal connection to the problem or have found through voice of the customer a problem that is acute. It's not just a pain point. It's an acute
Mhm.
pain point. It's not they're positioning a painkiller, not a vitamin, because the technology and the product often changes through iteration. So, is it a large and growing market? Market opportunity is probably second
Mhm.
to team for me. So I like those types of decks that will focus on why this, why us, and why now. Those are the three
Mhm.
that really resonate with me.
The three words, yeah, makes sense. Makes sense. You know, any startup ecosystem outside of the Silicon Valley, in early stages, they feel that we are disadvantaged because Silicon Valley is Silicon Valley. The ecosystem is very very mature. The investors are there, all sorts of from early angel investor to somebody who can give you a bridge round to go into Series A, Series B, and Series D, E, and F. All sorts of investors are there. In Virginia, how did you change that? Are you looking at companies who are just their market or TAM is local, or are you looking at founders who are building international or worldwide products? How is the ecosystem in Virginia?
Yeah, ecosystem in Virginia, I'd say it's growing. You have kind of two different parts of Virginia that we kind of some of us here refer to. We have ROVA, rest of Virginia, and we have NOVA, Northern Virginia and DC.
Okay.
So really, if you look at Northern Virginia and DC, which is not part of Virginia, but obviously it's right there. I mean, that's a more mature entrepreneurial ecosystem, primarily because you had AOL that kind of really anchored its place among national entrepreneurial ecosystems. You do have probably a more complete capital stack there. However, because of the scope and size and just geographic expanse of Northern Virginia, it's very disconnected. It's not a very cohesive ecosystem writ large. I don't mean that as a pejorative. It just kind of is. And then you have the rest of Virginia. And I'd say, you know, the startups in the rest of Virginia, the startup ecosystems are, again, 10, 12 years old. They don't have one particular company or industry that has just exploded. They're finding their way. But I will say, this is where you find the diamonds in the rough.
Mhm.
You don't have as much competition, which can be good for kind of scaling fast or failing fast. I think Steve Case, who one of the founders of AOL, really has summarized it best in his book, Rise of the Rest, where he makes the case for why he and his investment teams focus on these other markets that are kind of tier two markets like Virginia or outside the big metropolitan areas, because you have, I think, a sense of intense passion and heavy lifting that the ecosystems appreciate and necessarily buy into, because they know they're not Silicon Valley, but they know that in their own way they can compete among things that Silicon Valley can't. Kind of your cost of living,
Mhm.
quality of life. Again, I'd say that the competitive landscape's less concentrated in your backyard, which allows you for, I think, an easier voice of the customer, osmosis. So there's a lot of things going for it. But Virginia, I think, is, we just cracked the top 10 in venture capital dollars to companies. So we're getting there.
Yeah, yeah, great. Let's talk about the 757 angels. What type of founders do you cater to? What type of companies they are building? And what is your selection criteria? What a founder should do? What type of mindset they should have even before approaching your angel group 757 angels?
Sure. So, as an angel network, it's tough to really pinpoint a particular investment thesis that we have or a particular industry that we would prefer to invest in. I will tell you that, over the last 10 years that we've been investing, I'd say, med tech and health tech probably constitute the majority of our deal flow, and probably, if not a majority, close to a majority of our portfolio companies. However, we also have invested in food and beverage, and we've exited in one. We've invested in ed tech and have exited. We invest kind of all over. So, for our members, it's I think what's going to, can they see the exit? Can they see that path to an exit? And so the types of companies we put in front of them and source for them are going to be companies that, honestly, I would look at if I were running. I used to run a healthcare seed fund, and it's the type of
Mhm.
companies that, regardless of the industry, that I would look at from an early institutional side. So, when I do my vetting, it's like I said at the beginning of this podcast, I want founders who are humbly confident, who have executive function, who have deep domain expertise. I want a market that is, it's either a multi-billion-dollar market that's scaling or expanding, or a sub-billion-dollar market that's rapidly expanding to a billion plus. In terms of IP and all of that, that's down the list, because I want you to get out in the market and prove your product market fit. Usually the companies that come before our members do a product market fit, and they've validated their pricing model, and they're actually out in the market. I think the
Mhm.
whole angel space is at an inflection point, and that's a whole nother podcast, so I won't get into it. But all that being said, I place the same amount of diligence rigor on startups that come through our channels as I would a seed fund, early stage seed fund. So, again, at the end of the day, we're betting on the team, and then betting that the market is ready to accept that solution.
Right.
That you're going to have rabid users of that solution.
Mhm. You have heard so many founders, what is one of the misconceptions they have when they are pitching to angel group like yours about fundraise?
Well, I think probably, let's face it, everybody thinks that their idea is the best and that there's no competition and that they'll get funded, and uh, oh, we'll get what we need, we'll raise what we need in 3 months, and
Mhm.
it just never happens that quick. It's kind of like if somebody tells you they're going to build a house or a renovation is going to be on time and on budget. How many times does that happen? Very rarely. So, do I believe that great companies, all good companies are going to get funded at some point? But I think that is the biggest misconception, is how maybe that okay, we're going to fundraise this round, and then I can take a breather and focus on the business and then fundraise again. When in reality, because of the longer timelines for fundraising now, you never stop fundraising. The minute you're finished one round, you got to go right into the next one. So I think that's where that executive function comes in. The founder or founding team needs to figure out how to both manage the company, lead the company, and be the chief fundraising officer. So it's not easy. If it was, everybody would do it. But yeah, that's probably the biggest misconception, that it just the time, uh, the timeline of fundraising.
Yeah. So very interesting. You did talk about the executive function, executive leadership, and then the chief fundraising officer. Uh, Tell me more about it. Do you think that a company who are post revenue have some good traction building their company? Now they have a team. When they are approaching an angel group like 757 Angels or Thai Angels or Pasadena Angels, Tech Coast Venture Network, they should have a dedicated person in their team who is reaching out to the investors and making that relationship, attending the events, and promoting the company all year round? Or is it the role of the CEO to get more funding?
Gosh, that's a great question. I don't know if there's an easy answer. Maybe what I'll say is, I think it depends on the stage of the company. So, the later rounds, the A rounds, the A plus, the B rounds, investors are looking at more numbers and historical data than they are if you're at an angel or seed round. So, I think if you just focus on angels in the early seed, really, I want to see, because you're betting mostly on the team. Um, that I want to see the founder. I want to see the CEO in front of me. Now, I'm not expecting the CEO to necessarily be the one to pitch. I expect the CEO to be in the room because it's important. You're asking for money to fuel the company you're running. But
Right.
not everybody's adept at that storytelling, because it is definitely a narrative. It's a storytelling when you're pitching, let's face it. So if you have somebody on your team who is at an in the upper management or executive level that can tell the narrative, tell the story, get the investor excited, then I'm fine with that. But I think that's where the executive function comes in. As a leader, you should know who to pull in when to make the case. And by the way, that might be you. So I've seen
Mhm.
plenty of CEOs who are very good at that. But I just always tell them, the two most important hats you wear at the early stages as a CEO are, you're the chief executive officer, and you are also the CFO, but not the chief financial officer. You're the chief fundraising officer,
Mhm.
and you just, nobody likes fundraising, but it's a you just got to do it and kind of embrace the suck, as they say. So
Right, right, yeah. Chief fundraising officer, yes. And the presenter should be someone who can do the storytelling and can build the story up. And the obviously the founder and the CEOs, CHOs need to be in the room for that kind of discussion. How important is it for you, Paul, that the founder or the CEO or the leadership knows their number? I have been to some pitching event, or when people are pitching to me or SGC Angels, you start asking question about their numbers, quarter over quarter, month over month, growth, scale, uh, cost of unit produced. They don't know their numbers. How important is that for you? Or do you think that is okay? It is in the Excel sheet. We will get to it when we get to it. In my personal view, I feel the founder or the captain of the ship should know everything about the ship.
agreed. I couldn't agree with you more on this. I've seen it live in our pitches where we might have a really solid founder and a really good opportunity and good company, good product. But the minute that the members start to, kind of in the Q&A portion after the pitch, when they start to ask those questions, you can tell very quickly who's comfortable with answering those and who's not. And while I don't expect, again, the CEO to be the necessarily have a CFO, Chief Financial Officer, knowledge about it. Absolutely, to your point, at this stage, as the CEO, you absolutely need to understand the inputs that drive your financial model, that drive your business. If, for instance, you may not know if you decrease this widget by this dollar amount, how that reflects all the way through. That's fine, but you need to know what the pricing model is. You need to know that you have confidence in your financial model. You have confidence in your pricing model, because again, as you said, you're the captain steering the ship. If you have confidence in that and you have clarity in that, then your team will feel more that they won't be as anxious, and they'll have that trust in you that at the end of the day, you've got to build a sustainable business. You can't fundraise forever. So yes, very important for me, very important. And just one last point, I don't also necessarily care as much about stress testing okay, you said you're going to be at X millions of dollars in X number of months. That, to me, I care about the underlying assumptions. So if the CEO knows the underlying assumptions on which that financial model is based, that to me is more important, because then I can stress test that. So if you're telling me that the industry benchmark is for churn on a customer set is X, but I figure out it's Y, there's a problem there. But if we both, understand that it's X, okay, that tells me something. So.
Right. Great point. Let's talk about scale. How do you look at scale? What are the parameters in a startup journey for a founder? The way you look at it, scale, is it just scale in revenue, or what it is?
I think this one is always an age-old question. A lot of people, and I don't necessarily disagree, would say that the gold standard of scale is revenue traction. I think for a lot of companies, sure, certainly in the enterprise SaaS or just in SaaS in general, that you could make that argument. But if you look at other industries like med tech or health tech, where you have, industry gating, you've got, in the med tech space or health tech space, therapeutics or anything like that, you've got FDA gating. It's less about the revenue traction and more about where are you relative to the approval timeline. Similarly, you might have an industry where customers and retention and growth of customers is actually more appealing to a potential acquirer than revenue. So I oftentimes like to look at the end and work backwards when it comes to scale. So if we know that largely the acquirers in any given market like to buy companies based off of a particular metric, and it may not be revenue, then let's work backwards from there and figure out if that's the number one or those are the top one or two metrics that are going to guide a future exit. Then how do we measure traction against that versus just say, okay, let's do revenue, everything else be damned? Because investor sentiment changes over the last 5-6 years. You've seen it go from top line revenue, grow at all costs, to what are are you profitable? Are you unit economics profitable at scale? So I think it's a great question. And I think it's not necessarily as black and white as revenue or no revenue. It just depends.
Great. Thanks, Paul, for your answer. Let's talk about the Collab and the startup studio that you run. What type of benefit a startup founder is getting if they join, and how they can join it, and how the program looks like? What do you do for them?
Yeah, I appreciate the question. So 757 Collab is really a platform of startup focused programming and mentorship and connections and capital. So essentially, we are very well suited to work with high growth founders. So these are founders that are going to be scaling companies that are going to require some type of venture capital to scale and hopefully exit. At our very earliest stage, we work with idea stage to minimum viable product stage. kind of gets back to the traction piece that we just talked about. But that's our startup studios, 757 Startup Studios. That's where I would say we have top of the funnel exposure, but that's also our physical front door to not just the high growth entrepreneurial ecosystem here in Hampton Roads, but also to Collab itself. So founders can come in, especially if they just have an idea and want to flesh it out. It doesn't cost anything to join. We do have working on a better vetting system because we can't help everyone. But we are trying to figure out at the top of the funnel how to scale our advice and counsel most effectively. We then have our programmatic side of the house, which encompasses our accelerator. We are verticalizing around several industries that are very strong in the Hampton Roads market. Probably the most obvious one right now is water, because we've got Virginia Beach right there. But water and coastal resiliency, and then defense. We've got the largest naval base in the world. We've got NATO's headquarters. There's a whole host of Navy and military installations here. So we have a new defense accelerator for companies that are looking to transition into the government. So there's lots of different ways a founder can come into our ecosystem here, whether it's through traditional programming in a traditional selection process, or just literally walking into our space. We've got a great space and saying, hey, I need some help. So if we can't help you, we certainly have partners in the ecosystem that can, and we'll make sure that you get the advice and counsel that you're looking for.
Right, Paul. Let's talk about the founders. They are pitching. What advice do you have for them? What has been your experience, Paul? What the founders should do when they are in a 3-minute, 5-minute, 10-minute kind of a pitch over the internet? What they must do and what they must not do.
Yeah, I mean, you articulated so wonderfully that the problem that we see here. I think, and again, some of this gets back to executive function, right? It's first of all, how do you manage what's your time management skills? It's kind of a basic thing, right? So, I would say think about somebody who is unable to finish a 3-minute pitch tells me a few things. One, they might actually just be very nervous on stage, and that you can usually see that, and you give that founder some grace. I can appreciate that if you're not a public speaker. But for those that just go over, that they don't necessarily know their company as well as I would like to see them know it, because if they can't distill out what's going to make the most sense or most appeal to a founder, to an investor, then it's like, okay, well, that's I don't know, not a great sign. So I want to hear, I don't need to hear a long story about why you thought of this. I don't really care about the financials necessarily. Everyone has hockey stick growth. I want to hear, again, you can touch on a few things, right? Your team, and again, it gets back to why here, why us, why now. So you almost have to think, okay, what's going to be, what's the hook? And for some people, it's different for every company. But what's going to be the hook if they hear nothing else? What's the one thing in 3 minutes that they should walk away from? And then form what do you want them to, and then form your narrative around that. So at the very least, if you go over, you've already said the one thing that you want them to hear if they hear nothing else, versus leaving that to the end. So it's kind of like in school where they say, posit your hypothesis at the beginning, build it out, and then repeat it, right? So I think that's, I'm not answering this very succinctly. I recognize I'm probably going over my 3 minutes on this answer, but I do think that the ability for a founder or a CEO to practice, pitch practice, practice makes perfect. Practice your pitch, practice what you need to say. If you need to present it in 3 minutes, practice it. Don't go up there and wing it. Unless you're just a true pro. If it's 5 minutes, fit in at a five. And let me tell you, I would say that most often the investors are anxious for Q&A more so than hearing the pitch. So it's also okay if you can get your point across in 2 minutes. You've just added one more minute to your Q&A. So yeah, I think that's say what you want them to hear, support that, and then come back and say what you want them to hear one more time in 3 minutes.
Right. What is the fastest way a founder can earn your respect when they are in your collab or when they are pitching to you?
Well, ironically, when they're pitching to me, it probably dovetails right after what we just said. I really, it's a big turnoff if they just drone on and on, or they know that they've got a certain amount of time. I think, respect an investor's time as much as they want to respect your time. So that's one. I would also say, again, this is where the humble confidence comes in. Don't lose the arrogance at the door. Be confident for sure, because that's why you're doing what you do. But leave the arrogance at the door. So time management's probably the biggest. One other thing, if I can understand what you're building or your vision in 30 seconds or less, and I'm still at the end of your pitch going, I'm what are you doing? That's a turn off as well. So be very succinct. And I think there was one other part of the question. Did I answer the question?
Yeah. So in the collab also, so they are attending your collab, and there are so many other startup founders who are working with you. How do you pick the best in that, or what they do from your respect?
So the hardest thing about what we do, both from an investment standpoint, but probably more so from our programmatic elements, our acceleration and our incubation. Look, nobody wants to hear their baby is ugly, but sometimes you got to tell them that. And you can tell them that in a very professional and kind way, but you're not saying, don't take it so personal. And that's very hard to hear as a founder, because you're putting everything into this. But I would say if we say, you know what, you might need to pivot this. Don't get defensive about it. Embrace that feedback. And then let's talk through why we're saying it and why we're recommending maybe going this way versus that way. It's not because we think we can do it better, but we might challenge you on a few of your assertions just to see if you've actually vetted them. So don't get defensive about it. We're here to make sure that we accelerate and incubate and invest in the most promising early stage companies in our region. And, that by almost definition means that's not everybody, right? So I think that's, think of us as thought partners, not as somebody who's trying to necessarily, be a Mr. Wonderful to your pitch. He has a unique way of, at least on TV, of saying his things. So.
Yeah. How do you see the future of startups who are outside of Silicon Valley? We are about 400 miles. I'm here in Los Angeles away, and we are trying to build a robust startup ecosystem. Do you think, and America is such a large country, from Florida to East Coast and whatnot, and New York and then Virginia. Do you think there will be uh, you know more startup ecosystem and robust startup ecosystem will be coming up as regional hub? For example, Arizona is doing some great stuff with CSU. Great college student founders. They are, in research, R&D, all sorts of projects are happening there. Tile is playing a role in it also. What do you see in Virginia? And, do you think that, there will be regional hubs coming up in the next 5 to 10 years?
I do. I think, and again, not to be cliched in saying this, but I think COVID just upended the whole kind of entrepreneurial ecosystem dynamic, such that now that you've got hybrid teams, you've got remote. I mean, I can invest in a company in California by virtual pitching and meeting the founder virtually and arguably never actually flying in to meet the individual. And that was different prior to COVID. So I would say that with the advancements in technology, also with the advancements in AI, I think that's a game changer in terms of fail fast and scale fast, which means I think that's going to be, on the investor side, that's going to mean investing fast and picking the winners faster. So I don't think in that sense, you don't have to be place bound for that. I think, it's Silicon Valley and kind of the outlying hubs, I think, are always going to have this magic about them. No different than, Italy and French wine, right? And food. I mean, everybody loves that. So, I think that you will continue to see non-traditional markets expanding their entrepreneurial ecosystems and catalyzing them, because people are more. I think they understand there's kind of a democratization of opportunity that perhaps didn't exist as visibly or as obviously prior to the pandemic. I think we're still going to see the network effects of the pandemic even a generation later.
Yeah. So true, Paul. Plug in 757 Collab Angels. Once again, how founders can reach out to you. Are you really only talking about founders who are in Virginia, or you are open to founders to come and apply to you from all over the nation, maybe international also?
Yeah, no, I appreciate you bringing that up. So, for us, the easiest way is just to look at our website, 757collab.org. Collab is short for collaboration, obviously. But, for our incubator, we're focused on the Hampton Roads market. For our angel network, we're largely focused on Virginia. And then for our programming, our acceleration programming, we source from all over the country. So we kind of hit all the different buckets. So, and if you have any questions, we have, you're able to get in touch with us through the website. We respond to all the email, every email or every inquiry. So feel free to check us out.